To millions in China, Wang isn't just a brand, it's a memory. The hot kid mascot sits on holiday gift boxes and family tables, especially around the Chinese New Year, tied to moments of celebration and childhood. What it is: a mass market icon for rice crackers, flavored dairy drinks, and playful snacks. Simple, affordable, and everywhere from big cities to county towns. Decades of ads and corner store presence have etched Wang into the country's collective memory as shorthand for comfort and festivity. Here is the plan. We retrace the company story, unpack the business model, and review the financials. Wang China traces back to Island Foods in Taiwan, 1962. The Wang brand and its hot kid Wangzai mascot took shape in 1983 through a technical tie-up with Japanese Iwatsuka Confectionery. The group entered mainland China in the early 1990s, opening its first plant in Changsha, Hunan, and laying the manufacturing and distribution base that defines the business. The current listed vehicle was set up ahead of a Hong Kong IPO in 2008. Beyond paperwork, the brand is tied to memory. Chinese New Year gift boxes, corner store shelves, childhood milk drinks that bind hot kid to celebration and nostalgia. Wang is a mass market snack and beverage house anchored by the hot kid Wangzai character, a face most mainland Chinese grew up with at New Year family tables and school breaks. The portfolio spans three big families. Rice crackers, from classic senbei style sweet salty crisps to seasonal gift boxes, dairy and beverages, the signature flavored milk, ambient yogurt drinks, RTD coffee, fruit tea, and sports drinks, and sweet snacks, candies like milk chewies, jellies, waffle rolls, puffs, plus the Lonely God chips and summer popsicles. In recent years, the company has leaned harder into content e-commerce, vending OEM and export lines, while still pushing themed cans and limited editions to keep that nostalgia loop alive. By product, the latest fiscal year shows roughly half the business in dairy and beverages, about a quarter in rice crackers, and just under a quarter in snacks. The footprint is overwhelmingly domestic. The company repeatedly discloses that more than 90% of revenue and operations are in mainland China, with exports to North America, Southeast Asia, and Europe. On the revenue chart, the long arc is steady rather than spectacular, from 19.7 billion RMB in financial year 2017 to 23.5 billion RMB in financial year 2025, about a 2.2% compound pace over 9 fiscal years. What's more interesting is the plateau since financial year 2022. Management calls out softer consumer spending around Chinese New Year, which hit gift pack crackers, weather and timing effects on popsicles, and fragmentation in modern retail that cut store traffic. Those drags were partly offset by double-digit growth in emerging channels, content e-commerce, OEM, vending, and exports. Hence flat to slightly down top line, even as mix and pricing work held margins. On the EV to revenue line, you can see the multiple stepping down from earlier peaks, a market derating against a mostly flat sales base. With the top line flat and the multiple lower, the focus shifts from scale to conversion, how much each yuan drops through. Operationally, it standardized plants in China with full channel reach. Profitability is driven by the input stack, imported milk powder and sugar for dairy, palm oil for crackers and snacks, and packaging, paper, tinplate, films. Then by pricing, product mix, and factory efficiency. Keep that lens in mind as we move to margins. Gross margin moves with inputs. In financial year 2025, it sits high, around the upper 40s, 47.6%, because unit costs fell across key buckets, milk powder earlier in the year, plus packaging and palm oil, while pricing, mix, and plant efficiency did the rest. Late year firmness in milk narrowed the upside but didn't erase the gain. EBITDA margin lives in a 25-30% band over time. Think 3 bits. 25% in 2018 when input inflation and heavier promo squeezed flow-through. 30% in 2021 as inputs eased and costs were tight. Back to the mid-20s in 2025, even with a higher growth line, because seasonal volumes were softer, less operating leverage, channel mix diluted a touch, more emerging channels, and trade transport costs normalized. Against that backdrop, look at the aisle it plays out in. The packaged food aisle is ultra competitive. Flavored drinks face powerful locals. Illy, we covered it before, Mangno, Bright Dairy, plus a crowd of smaller brands. Sweet snacks are just as crowded. One exception stands out. In rice crackers, Wawan is the reference in China. That edge comes from a trans-generational brand. Hot kid on New Year gift boxes and corner store shelves, deep distribution into lower-tier cities and every major channel, and scale buying on milk, oils, sugar, paper, and tinplate. The weak points are clear: volatile inputs and growing scrutiny on sugar and nutrition. On EPS, the line just condenses everything we've seen on revenue and margins into per-share terms. It rises from 27.7 RMB cents in financial year 2017 to 36.7 in financial year 2025, a 3.6% CAGR, faster than revenue's 2.2% CAGR over the same span. The gap makes sense. Margin work and mix did some lifting, and the share count fell approximately 5.8%. On assets, the picture is light and aging. PP per share falls from 0.69 CNY to 0.43 CNY, which fits a refurbish and automate playbook rather than new plants, depreciation running faster than CapEx. On the right axis, market cap to tangible equity 3.1x means the market values the company at a little over 3 times its net tangible assets. For a branded consumer name, that's subdued. On balance sheet, it's clean and cash heavy. Cash sits in the mid to high teens, while gross debt trends down from 10 billion RMB to 4 billion RMB, so net debt is negative every year, widening from about minus 1.6 billion RMB in 2017 to roughly minus 11.3 billion RMB in financial year 2025. Return on equity sits in a healthy band, mostly mid to high 20s, with a clear dip in 2023 and a rebound to 25-26% in 2024-2025. The slight step down in 2025 versus 2024 reflects a larger equity base. CapEx is light and steady for a branded food name, typically 1.4 to 2.7% of revenue, about 2% on average. The chart shows a small uptick in financial year 2025 to 635 million RMB, 2.7%, after 406 million RMB, 1.7% in 2024. That rise is not a new plant spree, it's maintenance and optimization. Automation and layout upgrades, refurbishing existing rice cracker, dairy beverage, and snacks lines, and some packaging equipment. In other words, still low-intensity CapEx aimed at efficiency rather than capacity. Over the period, free cash flow is relatively stable. Not the drop from 2024 to 2025. That's mainly working capital swings plus the CapEx uptick we flagged earlier. On valuation, today's 15.6x price to free cash flow reflects that lower free cash flow. It's a mid-range level, not discount here, not cheap, reasonable. Dividends are steady and back to a normal run rate. Wawa has occasionally paid specials, notably in 2022, which pushed payout up toward 80 to 100% and make the later drop look abrupt. Without specials, financial year 2025 is just the ordinary final, 0.16 Hong Kong dollar per share, which works out to roughly a 40% payout on financial year 2025 earnings. The board doesn't anchor to a rigid target. Payouts flex with profitability, cash generation, and near-term investment needs, which is why they have swung up in cash-rich years and reset afterward. At 5.11 Hong Kong dollar, the stock sits almost on the regression line. That's roughly fair value on this long-run lens. On financial year 2025 numbers, it trades at 12.7x P. At today's price, it's 15.6x price to free cash flow, i.e. approximately 6.4% free cash flow yield. With 2% long-run growth and a flat multiple, that implies approximately 8.5% expected annual return. Wawa is a culturally embedded mass market brand. Hot kid on holiday gift boxes, crackers on family tables, and flavored milk in school memories. The company is past expansion and squarely in an execution phase. Steady sales, refreshed SKUs, wide reach, and a model built for everyday repeat purchase. Its strengths are clear. Transgenerational brand recall, deep distribution into lower tier cities and all major channels, broad portfolio that drives frequency, and a nimble refresh cycle. Seasonal packs, limited editions, content e-commerce that keeps the shelf alive even when the market is soft. The flip side is just as real. Ultra-competitive aisles, especially flavored drinks, sensitivity to input costs, milk, sugar, packaging, and little structural growth. Call it 2% a year, in line with inflation. So top line is more about holding share than expanding it. At today's price, and factoring in financial year 25's higher than usual CapEx, we can expect roughly 9% annual return on a flat multiple. A bit light for equities, but reasonable for a defensive name. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe, and share. And if you are interested in the company I mentioned, Ili Group, China's largest dairy producer, check out my full analysis.